Hey, Andrew, how you doing?
I'm well. Good morning, Corey.
Great. Thanks for coming in today, or at least coming on today, I should say. Usually you come in person, but this was sort of sudden because we knew the interest rates were going to be coming up. But I think the size of this hike and how recently since the last one that came out of the Bank of Canada, I think it's caught still some people flat-footed and is really sort of giving a bit of a slap to the head.
Yeah, nobody is more flat-footed actually than the central bankers. They basically were laid out of the gate, probably at least a year behind in terms of starting the interest rate hiking cycle. Just based on monetary policy with so much money printing. And so what we saw today from Tiff Macklin, governor of the Bank of Canada, is basically central bankers panicking because I want to be really clear about this. It's not because increasing interest rates at the central bank level is going to actually do much of anything to actually stop the price inflation that we have. But it's political because they've been forced into it by virtue of being kind of a political entity, in addition to being obviously an economic and monetary entity. And the reason why the interest rate increases are not going to have the price dampening effect that a lot of people think that they will is because this is not the price inflation that we're experiencing is not being driven by a robust economy with tons and tons of demand. This is being driven by supply shortfall, and supply shortfall is a direct result of shorter term and longer term policy decisions at the government level, not necessarily the Bank of Canada level.
And that's pretty distressing to think because one thing that raising the interest rates will do, though, is it will chill the economy. I mean, that's sort of the intent if you're thinking you're fighting inflation. Capital projects get deferred or at least scaled back. Mm-hmm. People are less inclined to purchase houses or do business starts if they have to finance.
Yes.
These rates are going to have an impact on us, and then we start fearing a recession.
It will have an economic impact unquestionably, but it's not going to do anything for price inflation other than perhaps in the housing market, and most especially in the three highest priced local housing markets, which would be the Greater Toronto Area, the Lower Mainland, and Vancouver Island. And those are the areas where the prices have been ridiculous for quite some time. But the fact is that they have a certain amount of limitations on supply, especially west of us, but also driven substantially by having a lot of demand from net in-migration, and so those are the areas that are going to have to see the biggest price adjustments downward, because the market always finds a certain equilibrium of price and volume, right? It's based on supply and demand. And so when the cost of financing a home goes up and people's wages don't go up as quickly as interest rates go up and the mortgage payments go up, the price of the asset, in this case the home, has to come down so that the payment meets the ability of the buyer to pay.
So we're kind of getting the worst of both out of this then. We're going to get the chilled economy, the pressure on us as individuals, but we aren't going to get the reduction in cost of goods and services. And it sounds like the Bank of Canada is signaling that they're going to carry on and increase these rates more in the coming future.
Yeah, we ain't seen nothing yet is my view. They're just getting started. And I would characterize this as being, all kinds of pain for very little gain in terms of intended result. The problems with the supply chain are mostly policy driven, as I mentioned. Now, so supply chains always are at risk of exogenous events, such as natural disasters, as an example, right? I mean, if you have a hurricane, that's going to close a port. If you have an earthquake, that might close a port and damage some rail lines and highways and all those kinds of things. So supply chains don't need policy decisions that are hurting, right? And when I say policy decisions, I'm talking about on the supply side, particularly with oil and gas. But since the beginning of the Russian invasion of Ukraine, basically almost all of the economic pain has been borne by Western countries, because the leaders of the Western countries said, well, we don't want to get into a direct shooting war with Russia. We'll fight to the last Ukrainian and give them lots of arms, but we don't want to get in a direct shooting war with them. So we'll try and punish them with economic sanctions. Well, those economic sanctions are effectively a giant economic boomerang, and they've come back and they have smacked the Western nations in the face.
Well, I mean, I guess, there's a lot to watch and a lot changing. Quickly, I guess, before I let you get back to work, like for those of us, people, of course, are worried about their investments, their nest eggs. How do you hedge against what looks to be coming here? I mean, are bonds going to start looking a little better if we're getting higher interest rates, or should we just be leaving our portfolios alone, or what do we do to ride this out?
Okay, that's an hour-long discussion, but
Yeah,
I'll be as brief as I can.
You
So
guys
rising,
specialize in it, and I know there's a lot more on your website to cover, but
right, rising interest rates are going to hurt bonds. Now, if you're buying bonds fresh, you'll get a higher yield, which is great. There may, at some point in the future, be some room for capital gains if they have to drop interest rates again. If we get another economic blow, but for the major trend is upwards in inflation and in interest rates. So the fact is that traditional bonds are actually a very unsafe asset class going forward. Stock markets, commodity markets, bond markets, they are all discounting mechanisms. They look out into the future and they price in what they think is going to happen. They usually overshoot both on the upside and the downside. In this case, they priced in a recession. And that recession is being driven by demand destruction from high oil and gas prices. So it's going to take, and fertilizer, natural gas, all those things that we know are a problem. So in terms of what to do in a portfolio, I would say the worst thing to do right now would be to react and turn temporary declines into permanent losses. But that doesn't mean you should be oblivious or passive. Start looking for new ways to actually profit from inflation. And it takes time for stock markets and commodity markets to adjust. But I think that most of the pain is already in, at least I hope so. But longer term, companies raise their dividends. Great companies raise their dividends faster than the rate of inflation, which drives their stock prices back up. And if they're selling a commodity with a long-term upward trend, they will also benefit.
Very well. The most important and first part of advice, of course, was don't panic. Just work with things with a plan and so on. And that's just where I wanted to lead you, because I know in our quick 10 minutes here we won't have time to cover it all. But that's your specialty. I mean, you hold entire webinars and things such as that to help people with all those sorts of things. So maybe before I let you go, then where can people find more information? Because a lot of people are worried and concerned. I mean, they've been saving, their retirement's looming, or maybe they're already retired. They want to make sure that they can weather this storm.
Well, as you can see by the backdrop, we're Integrated Wealth Management, and you can type in integratedwealthmanagement.ca. And we also have a new web domain. It's i-wealth.ca. So integratedwealthmanagement.ca or i-wealth.ca.
Great. Well, thanks for coming to, explain a little bit what's going on with this. It's important to know those differences. For example, as you said, there's different types of things pushing inflation. If it was a red hot economy, that's one thing, because at least it means things are moving. But if it's supply chain, then you really got to be careful with that economy, because you cool that down, we're going to make a lot of trouble.
Yep. This is cost push, not demand pull.
All right. Well, thanks. Maybe we'll check in as things develop down the road here, and I appreciate your input today, Andrew.
My pleasure. Have a good day.